There are more shutdowns happening around the country. We want to gauge how many of those service sector workers are now being sent back home again. And I think that's what investors are watching for as well. Are we seeing the real economic damage from that yet? And that's where you would see it show up first. So I think that first and foremost out of something like 10 data releases is going to dominate the morning. And then we move into the FOMC minutes this afternoon, and that's what people will be keenly focused on.
Are low rates going to be here for years, Ellen?
Okay, you throw me a softball question this morning. Yes, that's an easy answer. But I think in the near term here, what investors are watching for is, in the minutes this afternoon, what does it show was the discussion, the evolution of the discussion around how the Fed feels about how long asset purchases might continue, and also any hints of whether it would extend the maturity of its purchases at this upcoming December meeting. In that regard, we think it's only about a 35% probability that they do that at this meeting because financial conditions are extraordinarily easy right now, and they only need to move to offset that. But yeah, interest rates low for an even longer time under this new framework of theirs, absolutely.
Okay, how about this? Not a softball, because a few years ago, everybody we talked to said, where will interest rates be on the 10-year at the end of the year? And it was like 3%, right? We obviously know those people were spectacularly incorrect. And then, by the way, rates moved down before the pandemic. Yeah. I think inflation could run hot. That's why we talk about commodities a bit. What would force the Feds? Is there anything that could force the Fed's hand to actually tighten monetary conditions?
Well, it can. I mean, so as we've had a very out of consensus view, an unpopular view for some time, that inflation is going to be rising here, both in the medium term and also long-term structurally higher inflation. And there are myriad reasons for that, but a big part of that is also this new framework from the Fed that you let the labor market get as tight as it possibly can. You continue to support the economy and inflationary pressures for even longer, say 2 to 3 years longer than you did in the last cycle, in order to ensure that inflation is going to rise and stay above your 2% goal. So the Fed itself is going to be driving inflation higher. So it's going to resist raising rates even as we move to and through that 2% goal. Now, could they raise rates earlier than, say, the markets expect? Markets are pricing in sometime by the end of 2023. Absolutely. We don't know exactly how the economy will unfold, say, in 2022. But the first thing the Fed has to do is take its foot off the gas pedal by tapering its asset purchases. And we've got to get through that first before they can raise rates. And thereafter, Brian, and this is what I think is the most important point, is not when do they start raising rates, but at what pace do they do it? I think in the beginning, they're going to raise rates and then they're going to do it. They're going to get off of zero and then they're going to go from thereafter very slowly. I think that's a big story that we see for EM, supporting EM, versus the last cycle when they went too quickly. So I think it's how do they redefine gradual in this cycle, I think is going to be very important.
Shepard Smith here. Thanks for watching CNBC on YouTube.